Stock sectors, risky stocks that soared from the stay-at-home economy, now ready to fall. All right, you're going to enjoy this. I think we're going to look at some good opportunities here as we look at 16 stocks. We're living through a period of strange dichotomy as the economic crisis and the stock market diverge in a giant way. Some stocks have just surged to new highs in this strange world that we live in. And COVID-19 shut down the world, and now they're trying to partially restart it. And we're left with a stay-at-home economy that is certainly going to go on for many months, if not for many years. And our economy is significantly changed, and it can be in a very permanent way in some aspects. Some of the stocks that soared had gone nowhere for years, nothing like this, and some had gotten killed and then rebounded in this surge in this unique group of stocks. The stocks, some of them were relatively new listings, and they really attracted the attention of investors in this unique economic situation. Many of them went up to ridiculous valuations, some that it would take many years of earnings to justify for those companies to catch up with these stock valuations, if they ever could. I looked at the top 40 or 45 best performing stocks that benefited. They moved up really because of this crisis, and most of them moving up to either major recovery highs or all-time highs. And I sorted through them, looking for at three different kinds of criteria. Some of them were okay. I simply scratched them off because they didn't meet our criteria. That the pricing was not all that crazy, and maybe looking out, they had realistic potential going forward. Some of them were massively overbought and certainly overvalued, and some on the list of ridiculous as far as the pricing goes. I put out a little teaser on this showing one of those stocks and the kind of analysis out on YouTube a couple of days ago, just as I was getting ready, as I was doing this analysis, and I knew there were some 16 stocks total that fit into this category. So what I looked for were really three pieces of criteria. They had to have these massive moves that were due to the COVID-19 crisis. They had to be trading at enormous PEs or high PEs for the stocks that did actually have earnings. Some of these are some widely held names. And the PEs are high for these companies, but maybe not that outrageous. Facebook is a good example of that. I'm going to start out with Facebook after showing you Etsy. And then the other measure was that they had to be overbought by some measurable amount with downside targets that I could come up with for a great trading opportunity that I think is setting up right now. Some of these stocks, of course, might make it a little bit higher. It doesn't mean that the highs that we're looking at right now are the highs. It's up to you to take ownership of the trades and decide what really fits for you. But I think you're going to find that this does point out some opportunities. Remember, we're looking for risk reward. In other words, the probabilities of these stocks going higher versus turning around and going lower. I really tried to look at stocks that had at least 10% at least probabilities of 10% declines, and some of them will be much greater than that, 20% declines. So, we're always looking for best entry for the, to get these probabilities in our favor. And that's why I bring a group like this, the risky stocks that soared from the stay-at-home economy. These stocks, again, are handpicked out of a lot of stocks that did very, very well during this period. So we're going to start out looking at, we'll come back to Facebook because I want to start in Etsy. because that's the one I just shared with the public. And this one is already, turning down, as you can see. So for those of you that are new to our analysis, this is cycle analysis. What we look at are the rhythms in the market. It is essentially a picture of money flow. There are distinct rhythm in the market, and a cycle is measured from low to low. Low that you see over here, and low that you see over here. And there is a repeating rhythm in the markets. This one happens to have a head and shoulders in there that was made by the 3 cycles. You can see 1, 2, 3. And if you measure from the top of the head to the neckline, that's where you get your downward projection from this line right over here. And you could see that it easily made that. This was a negative cycle here. It rallied into the sell zone and came down again. And then it produced this island over here when we went into the COVID crisis. Now, the crisis we're in, the stay-at-home economy, meant that people would be buying online. So a lot of the online stocks went ballistic. So if you look at a stock like Etsy, for this year, they're expected to earn 42 cents. The coming year, based on, I think, very exuberant earnings forecast, is 96 cents. Their forward PE, when I look at this and extrapolate out about forward 12 months, is around 90. So you see it was just a massive price level when it was getting up at this area. So what I look at is this bottom that came here and made this island, and I have an anchor point here. And then I look at the top right over here, and you can see the engulfing pattern right there that is proving the top. And then what I do is I use those anchor points to project on the downside. So this was an 88 high. We're projecting down to 65 or lower sometime in July. And you're going to notice a commonality as these stocks are synchronized. That might be the principle of synchronicity we're looking at, that brings them down into similar time frames. And in line with what we're looking for in the stock market, a decline into the mid-July to early August period. So you can see this one has already started down, and this one might be, you might have to wait for an uptick in here to get the best short side sale, but that's what we looked for. Cyclical patterns we could read, as you can see, some of them will have that. Huge upside moves based on the stay-at-home economy. A ridiculous valuation that we see right over here. And then the last part of it is a measurable disparity that shows us that is extremely overbought. Now, you'll note in here the 34-week moving average as you see that coming up here, and how each of the cycles came down and tested that 34-week moving average. And then when it broke, it came up and tested the 34-week moving average again. That's our key moving average that we're looking at in here. Here was a whipsaw right over here when we went into the crisis, where a massive liquidation beat it down, made the bottom of that cycle right over there, and then when everybody realized that people were staying at home, they started buying the stock. So from the 34-week moving average, and sometimes it's from the 13-week moving average, we can extrapolate that the distance from it was extraordinary. So that's how we're measuring an extreme overbought condition when we look at that. And it is the 34-week moving average, or sometimes the 13-week, they're like magnets. I mean, if you believe in reversion to a mean, then you can use these as mean levels. And you can see it's coming up and might actually get up into this area over here, but that's why we project into this support zone area over here as a likely decline to the 65 level. So that's a pretty extensive look at how I did this research and why Etsy was one, and I showed this one out on YouTube. For those of you that are not YouTube subscribers, you might want to subscribe to us on YouTube, because sometimes we put little clips out there, which are repeats of what our members get 99% of the time. This one just was not. It was a teaser I put out there because I hadn't quite completed the analysis when I put that out on Monday night. So now the other 15 stocks I'm going to share with you, nobody has seen before. So this is going to be this comprehensive list of stocks that I use similar analysis with. And what I'm going to show you is in order of PE and in order of the stocks that I think have the least amount of risk or the most amount of risk based on valuation. And we're going to kind of go in that order. So Facebook is the next one. Now, Facebook has got a huge lift based on people, of course, being online. I happen to think that for most of these companies, I'm very bearish in Google, but it didn't fit the criteria in here. And that's because businesses are just not going to be spending the kind of money for online advertising in this environment that we live in. But in the case of Facebook, it's a little bit different story. And I want you to note in here that I have a buy zone in there where I think it's going to come down to. So the target down over here is close to 200. From the peak it made at 237, and it is very near the peak right now. Again, you will see that there are cycles in here and how they line up. The low over here, these are kind of timing spikes I put in here for you to see the approximate lows and how they line up cyclically with these distances between lows, very similar. We look at average length. It doesn't have to be right on. And then you had this big rally to this all-time high. Now, part of what's lifting it up is Facebook Shops. I think Facebook Shops is a winner. It's a perfect fit for where they are right now and their business model, and that is very, very likely to be a benefit for them. In fact, analysts thinks it could boost revenue by $30 billion. So that's a good thing. However, it got massively overbought. For this stock with a 24-25 PE, it is high. However, not anywhere like some of the other stocks. So I'm starting with Facebook because it's got downside risk into the buy zone. I think it's going to decline. This would be the 213 would be the best that I could see. So 20-point decline, very worthy of a short, and potentially making it down over that 10% level from that peak. So Facebook is the first one that I'm showing you that is setting up for a pullback in an overbought situation, very far from that 34-week moving average. Look at the rest of the chart and how each cycle gets back to the 34-week moving average, back down through it, and look how far it is from it right now. It's a very important way that you can measure an overbought or oversold condition. When it gets very far from it on the downside, as you see what happened in this very negative cycle here, well, came right back to it. You can see that. So that is a very important aspect of your analysis, is understanding how far it is on a particular move from that moving average, which again is a magnet. So that's a look at Facebook. The next one we're going to look at is CTXS. So Citrix Systems, well, this is another one of those stocks that since my analysis started 3 days ago has pulled back pretty sharply. So this one I didn't put any targets in. It's already getting down over here. What I want you to see is that if it rallied again, that would give you a short entry in this stock. It's a 25 PE. It benefited from that stay-at-home economy in this networking category, because networking is so important for enterprise as far as people working from home. So this stock had a big break already. It's not going to give you a great entry right now, but look what the 34-week moving average is. You can see the 13-week moving average. So if the stock got a rally back up into these areas over here, and momentum is turning down, you can see that little momentum right there, that would, in my opinion, give you a shorting opportunity. So you can see that I'm kind of starting out with the ones that are opportunities that are not monstrous opportunities. Clorox, which of course soared, that's this big line you can see right over here, because they were selling out of Clorox wipes everywhere, then came up and tested that high and then turned down. So Clorox, we're looking for a pullback to about 183. So that would give you from that peak over the 10% level. Again, this you probably are going to get a better entry in this one in Clorox. But that one, a very, very likely pullback in there. Right now, the risk rewards are not as good as they would be if you caught the stock trying to get back up near that 210, 208, 210 level. So in this one, you're going to want to wait for a return back up. 30 PE, which I haven't listed on here, it's actually a 30, is very high for this, which is a pretty defensive stock. So you can see this kind of a giant move just does not happen. Look at the distance from the 13 or the 34-week moving average. It's quite far. It's very likely to move back to 185. You can just be a little patient and wait for a little better opportunity. PayPal, certainly a stock that has a lot of opportunity in a stay-at-home world. Got extremely expensive and has not pulled back yet. So you can see in here that the stock gets up to 151. We're looking for a pullback to about 134, the top of that area right over there. Now, for those of you that are cycle analysts, that are students of our work, you'll note that I create an upper buy zone in here. This is one of those stocks that I think is going to do well in the continuation of the stay-at-home economy. While we're looking for this 10+% pullback in here, and probably takes you into July, just like many of these stocks we're showing you, this I think is a quite investable stock when it pulls down over here. So I think you have a short sale opportunity right in here, and we're looking for the market to move up until June. So that probably gives you a little higher price potential right in there in PayPal. And then catching it as it moves down, and it squeezes a little bit of that 40 PE out of there. So you can see we're starting to build PEs. Some of these stocks in this earlier analysis are stocks that you might actually want to buy after the dip. But later on, as we're getting to the ones that are more extreme, maybe not. Netflix is the next one we're going to look at. This is a 50 forward PE. It is nuts. It moved through that target zone over there that we had in there, so it did pretty much what we expected. It looks like it's failing below that next fib extension zone up there. You can see we had two different projections based on the quality of the advance. It really looks like it's peaking to us. So we think that in this period in June, up through June, 440 to about 460 is the shorting zone. And our downward projections right over here, based on these two different projections, really makes sense to get down under 400 in here. So if you get up to, maybe 440, 450, I think you got a very reasonable 10% decline in Netflix. Extremely expensive, 50 PE on very, again, exuberant earnings forecast in 2021 of 860. When the competition is just massive, and their costs of creating this content is just getting crazy. So earnings, I don't think are going to grow that fast. The PE, the stock like this make one mistake, and you know what they do to it. So this is a stock that I think is going to give you a good opportunity between now we're here in the third week of May, so the next 3 weeks I think is going to be a very good shorting opportunity, and that's in line with our stock market trading in there forecast. So the next one we're going to look at is Amazon, and I think Amazon is going to be negatively affected by Facebook shops. This has our colored phasing in there, and this stock gets up to 25.25. It kind of hit the target down over here we were looking for, and then moved up. So what we have is multiple cycle harmonics in here. This was the minor cycle that bottomed right in here, and now you could see it rejecting that level over there as it hits the top of that broadening pattern. We're looking for a decline to 23.10 or down over here to 21.86. Again, into July. You could see this nested area right over here. That's a lot that's pulling down in there. When you get a forward PE of 65, you know that this thing is way overbought. A $40 projection for 2021, I say no way to that. They have come out and said how expensive it is for them to do this business that they're benefiting from in the stay-at-home world. So those earnings are very unlikely to grow at that kind of a rate. I think the stock is very overbought, and again, you can see it rejecting in there already. We think that in this area between 2,500, 2,525, it is a very good risk reward for making a play for that pullback that we see in here. Again, we're going to look at this moving average right over here. The 34-week moving average is right over here. See this cycle, tags it. See this cycle right over here, gets down through it. This cycle right over here gets down through it, moves way above it here. Look where it is. It's coming up right over here at 2,000. This one over here is the 13-week moving average. That's the most bullish case that I can make looking at that. So I just want to take this right over here, and I want to drag this forecast down lower right there because it just makes much more sense, 2,200, when I look at that. So I think Amazon, it's a hard one to trade. You know, if you're a trader, trade out, you don't want to be in the short side. You would be then looking at option verticals, either on the put side to buy them or the call side to sell them. Don't hear that as a recommendation. I'm giving you a model of a way to approach a $2,500 stock. So that is a look at Amazon as we go up in PEs and go up in risk. Why I say go up in risk, much higher PE, extreme crazy projections on earnings, and this crazy distance from that 34-week or the 13-week moving average. Very likely to have that pullback again into July or early August. So now we're going to get crazy as we look at, and maybe you could tell me what's so good about Wingstop under these conditions. Over 100 forward PE. Well, what are they going to deliver in a huge amount of chicken wings more to people's homes? Well, maybe. But this is insane. The stock goes from $44 up to $131 in just 8 weeks, 9 weeks. It's sick. This is an extreme valuation. Again, look at the 34-week moving average and the valuation of that. This one only got to the 13. That was really bullish. So you can use that to tell in these patterns how strong or weak it is. Gets down under the 34, under the 34, extreme, gets back up through it, and here it is right over here coming up towards our projection of 100 on this stock. This looks like a screaming sell to me right now. I think it is nutty to be at this level, and I'm looking for $100 on the stock as a best case between now and mid-July. So that is the entry into the nuts, into the stocks that are in crazy land. The next one is DocuSign. Well, of course, DocuSign is going to benefit from not signing documents in person anymore because you need a face mask and gloves if you want to get near anybody. So this is a world of people wanting to stay away from other people, but that world is changing. And, I'll make this one statement right now, and that is if the world right now is fighting so hard to normalize, and the Fed is pushing so much money everywhere so that companies can reopen and companies can pay their employees, if that is all so good and the stock market is rallying so strongly based on that, doesn't it mean that the stocks that have done so well based on the stay-at-home economy should then be liquidated? Doesn't it certainly mean that all the money that's come into here should go into stocks that would be recovering? These make no sense to me. 120 forward PE on Dreamland of 84 cents earnings in 2021. Our projection is 110, probably more like 100, and a very potential 25-30% decline in this stock. Again, you can see we don't really have a turning down of any consequence until we get into the June here. So you might get a little higher prices. There is a fib extension here up around 143. If they want to get nutty and push it up higher, they certainly can. But again, we're looking at risk rewards, and there's a entry coming in here. Or if you're long the stock, you got to look at this and say, well, I mean, look at that 34-week moving average, and what it does, it crosses it, and look where it is right over here, coming up into the 90s. It's in the 80s right now. This is massively overbought, massively overpriced, and very high probability of moving to the downside. Some of you are going to get into these, and you're going to get in, and they're going to move up again, and you're going to say, wow, was Slim right? Or did I get in too soon? Or maybe Slim is just wrong, and these crazy stocks are going to get even more crazy. We're looking at risk rewards, and those risk rewards say these stocks are in fantasy land. Next one we're going to look at is a SHOP. Shopify, a software platform. Let's just look right in here. This one 1,000 plus PE if they have earnings, right? They're losing money this year. They're projecting making 54 cents next year. $800 stock. This is on essentially platforms that give you the ability to create shops and stuff like that. It's so I mean, look at this. I mean, what can I say? Look at the 34-week moving average, down now at $445. All right, let's take the 13-week moving average at 537. The stock is 800, 1,000 PE. Look at the cyclical patterns that call for a decline into early August. Okay, I'm going to make a best case. The stock moves from 800 to 600 sometime between now and sometime in August, and that is a bullish case that I'm making to you. Craziness. And when I look at this, 1,000 plus PE, even if they make 54 cents, at 800, they're at a 400 PE. If they make 54 cents, the stock is still going to fall. How do you like that? And now we're looking in this window of the next couple of months, and we're looking for swing trading opportunities. And there's lots of people that are long Shopify now that are going to say, well, this stock is going to do great at a stay-at-home economy. The company. Well, if the company does great, it doesn't mean the stock is going to do great. This stock is priced for the company doing great for the next 10 years. So it makes no sense to me. Like I said, we're looking at banana land right here, and this is a stock that is just priced for perfection for the foreseeable decade. I mean, nutty. Okay, the next four we're going to look at have no earnings. So there's no PEs to talk to you about. This one in here is DDOG. A lot of these maybe you haven't followed, DDOG. It's too early for cycle analysis. This was an IPO back in 18. So I really need more information to give you cycles in here. As a matter of fact, when you look at the 34-week moving average right over here, you're only just barely getting it. Look where it is, way down over here at $40. The stock is at 72. They're in information technology, is what they are. Yeah, maybe they have a huge future, but in my opinion, the huge future is too far out to be looking when you have something like this. In 2021, they may actually lose 3 cents. So this stock, best case I can make is a pullback in here. I don't have any projections. 55 is the top of that. I mean, here's where the 23% is, which is way too positive, if you ask me, down to about 62. At some point, it's going to top in here. They're going to realize that this is going crazy, and maybe it's, again, into that July period. But I have no cycle analysis to show you, so you can see that. The next one is like an Etsy. Etsy sells, craft, arts, stuff like that. Wayfair is another one, and you can see this one turning down already. Now, this one has got cyclical harmonic families that are very clear. You could see the minor cycle, you could see the dominant cycle, and how each of those dominant cycles have 2 minor cycles in it. And right now we're in the declining phase of the minor cycle that projects to about 130. The stock is 162 after making 197. Look at the earnings. 2020, they're going to lose 860. 2021, they're going to do much better, lose $7. Can you explain this to me? I mean, the only explanation is that people went crazy. And because they sell online, they had to own it. I'm projecting 110 on this stock in September. You could see it has a longer cycle than some of the other ones we're looking at. So it would be a drop into June with maybe the rest of the market, late June, early July, to about 130, maybe another rally, and then getting down to about 100. Can you see all of those projections in there and how clear it is? Look at the 34-week moving average. It's actually just turning up. And when you look at this one right over here, that's the momentum indicator. So that's not the one that we're looking at. We're looking at this 34-week moving average. Right now it's at 93. It'll work its way up here to about 110. The stock 162 after trading 197 with nothing but losses ahead. Unbelievable. I love buying from Wayfair, actually. We bought some things from them that were damaged when we got them, and when we call them, they say, well, give them away or throw them away. We don't even want the stuff back. Well, I think it's great. We donated some great stuff to some charitable organizations. Just had a little damage on it, so and they send us a new one. It's great. They have goodwill that's off the charts, but of course, maybe their goodwill costs them money. I can't see how Wayfair is going to do anything but move down, except in moments where the stock market drags it up. This looks like a top that is made to me. I don't think you'll see 197 again, but we're leaving a little room for that in this projection right over here. It probably should be projecting to the downside right now. So Wayfair, no earnings, looking horrible. Two more to go. EVBG, maybe not one that you have seen before. Oops, EVBG. I don't think I could type it. That's the problem. EVBG. There you go, Everbridge. I don't know how to type it because it's a stock that I hardly look at. Look at the engulfing pattern in here that is here already. The stock has made a peak. You can see that right over here. So I don't have projections in here. That has no earnings. If I were to project, I have to project off of this cyclical low right over here. And you can see the cycles in here. And look at the 34-week moving average coming up to here from about 97. The stock makes 165. You can see that. So what are we looking at in here? So what I thought I would do is I would do the swing high, swing low analysis in front of you. And you can see that right over here. So that cycle right over there gives you a midpoint of about 130. So the stock is 142, down to about 121. If you take it from this low right over here, you begin to build confluences of supports that come in right into here about 125, 121. You can see that right over there in kind of the mid zone. So this stock to us looks like it's got about another 20 points on the downside. Again, what I would like to do is I would like to let this stock rally back up in here to get an entry and then look for that play down over there. No earnings in the foreseeable future, and a pretty good likelihood that this stock is going to be moving down to somewhere down in this area right over here in this time frame in September. So Everbridge, they're in software application. What they do is they give you disaster notifications. Well, it would be nice, for somebody to tell me when a hurricane is coming here in Florida. That's good. I don't exactly know why a company that loses money should go up to $165 based in this environment. So it's you can see the reversal happened already, and there's probably going to be a better entry. The next one is, or the last one we're going to look at is PTON, a Peloton. So this, of course, is the exercise equipment, and I don't have any cycle analysis in here either. This stock is not mature enough for that, but you can see in here that the stock made almost $50. That's after trading at $17 down over here back in March. $17 to $50, almost a triple in there. Here's your supports. Here's your moving averages coming up. The stock is probably $33 as the market pulls back. I think this is insane. Again, you might get a little better entry here on the upside, but I think it's very likely you're going to see this level, $34, something like a 25-30% decline off of those highs that we have there, and you might have a little better entry in this one coming up. So that is a look at Peloton. I said Peloton, I think. Peloton. And too soon for cycle analysis. Not too soon to see that they're a losing company and that they have gone crazy. Maybe they'll have a good quarter of earnings because people buying these exercise bikes and stuff to put in their house, they have great products. Sadly, for a lot of people, they're going to be clothes hangers, and that's just what happens. And then all of a sudden, the burst in sales disappears, and that sets up for the disappointment that I think is coming in a stock like this. So that's it. I showed you 16 stocks that soared from the stay-at-home economy that are ready to have significant pullbacks. Remember the analysis I used: massive moves on the upside based on the stay-at-home environment. Trading at enormous PEs or just high PEs for the particular company they are, if they had any earnings. Measurable overbought conditions based on these key moving averages that tend to be targets or magnets, and what I think are good trading opportunities for declines of at least 10%. So, and that is between now and September is what I showed you, with the majority of them bottoming in the period between sometime mid-July or early August. Shorting opportunities that I see as they fit into your own trading style, not my trading style, and that you can get into these in a proper way, take ownership of the trades, make sure they fit for you, look at the targets, look at the time frames, and then you can set up the proper parameters for your trades. Some of these will be buys and are investable because the stay-at-home economy is here to stay for a long period of time. And some of them, if you believe that, for the next years they're going to really benefit. I mean, you look at something like PayPal. I think that's a good example of that. That they're going to benefit for a long period of time. I think that stock has done great. That company has done great after they were spun off from eBay. So that's kind of example of some things you might like. Clorox. There's going to be demand for wipes, but I just got wipes for a lot less money, a lot easier from Costco. So those supplies are coming out. So a 30 PE in Clorox is a crazy PE, and some of these other ones I showed you, well, like I said, fantasy land. I hope this was great analysis, that you can adopt some of this for your own trading style, because we're here to educate you. We're here to bring my 45 years of experience to you so that you can improve your own trading and raise your odds of success. That is it for this video. Please do always let me know how you liked it or how I could improve it. That's it, and I'll see you in the next segment.